Hello! This is the 43rd episode of What Would Peter Lynch Do?, where we explore the wisdom of legendary investor Peter Lynch. We got a great question from a listener who said, I want to invest in TSMC, a global semiconductor factory that has driven the rise in semiconductor stock prices. Can I invest in the US stock market?
And you know, it's a fantastic question, right? You see this absolute powerhouse of a company, a real world changer, but it's based overseas. So you're left wondering, how in the world can I get a piece of that action as a regular investor here in the US? Well, let's get right to it. The short answer is a big, resounding yes. And understanding the how is, honestly, your key to unlocking a whole world of global investing right from the comfort of your US brokerage account.
So you're probably asking, how does that even work? Well, it all comes down to this really clever financial tool called an American Depositary Receipt, or as you'll hear it called, an ADR. Just think of it as your golden ticket to investing in all sorts of global companies.
Okay, so what is an ADR really? In simple terms, it's a certificate that's issued by a U.S. bank. What happens is the bank goes out and buys a whole bunch of shares in a foreign company, holds on to them, and then issues these receipts, these ADRs, right here in the U.S. And you can buy and sell them just as easily as you would a share of Apple or Ford.
I love this analogy because it makes it super simple. Imagine the actual stock of TSMC is this amazing, super popular snack that you can only buy in Taiwan. Now, instead of you having to fly all the way there, a US bank buys that snack in bulk, and then it sells you a snack coupon here in the States. That coupon, that's the ADR. It represents the real deal, but you can trade it super easily at your local store, which in this case is the New York Stock Exchange. Pretty cool, right?
So what this process creates are two different ways to buy into the same company. Over in Taiwan, the original stock trades under the ticker 2330, and it's priced in new Taiwan dollars. But here in the US, you buy the ADR with the ticker TSM, and you do it all in good old US dollars. Now here's a really key detail you got to remember. For TSMC, one ADR share that you buy here in the US actually represents 5 shares of the stock over in Taiwan. Now while ADRs are definitely the most popular route for foreign companies, they're not the only way for them to get listed here in the US. Let's take a quick look at the 3 main paths a company can take to get onto Wall Street. So first, a company could go for a traditional IPO. It's a huge, complex process, but it's great if they want to raise a bunch of new cash. Then you have the ADR route, which is what TSMC did. That's perfect for just giving US investors access to shares that already exist. And finally, there's something called a direct listing, which basically just lets existing owners sell their shares on the open market. Each one serves a totally different goal.
So, just how common are ADRs? Is this some sort of niche, back alley thing? No way. We're talking about more than 2,000 foreign companies using them to trade in the US. It's not a side road. It's the main superhighway for global companies that want to tap into the American market.
And I bet you've heard of a ton of these companies. We're talking about giants from Japan like Toyota and Sony, all the way to the UK's AstraZeneca and Brazil's Petrobras. These are massive, household names, and they're all available to you as an investor right here, thanks to ADRs.
Okay, so this all brings us to the most important question of all. What does this actually mean for you, for your portfolio? Let's really break down the pros, the cons, and what you need to be aware of.
The biggest pro by far is just how incredibly convenient it is. You use your normal brokerage account, you trade in US dollars, no funny business, and you get the safety blanket of SEC regulation. On the flip side, what's the catch? Well, your selection is limited to companies that actually offer an ADR. There's a little bit of hidden currency risk baked into the price, and you might pay some very, very small fees to the bank that manages the ADR. But honestly, for most of us, the convenience and safety are absolutely worth it.
This leads to a really logical question that a lot of people have. If the ADR in the US and the home stock in Taiwan are the same company, why on earth do their stock prices look so different?
And the answer is, they're not actually different. It's kind of an illusion. The price gap you see almost completely disappears once you do the math. You just have to account for 2 things: the currency exchange rate between the dollar and the new Taiwan dollar, and that 1-to-5 share ratio we talked about. Once you factor those in, you see the values are practically identical.
And what if a real price gap ever does open up? Well, the market has this amazing, almost magical self-correcting feature. It's called arbitrage. The moment one version of the stock gets a tiny bit cheaper, big institutional investors swoop in, buy the cheap one, convert it, and immediately sell the expensive one for a quick, risk-free profit. All that activity instantly pushes the 2 prices right back into line. It's fantastic.
So now that we've got the how down, we understand the mechanics, let's zoom out and talk a little bit about the why. What do the investing legends think about this whole idea of looking for great companies outside our own backyard?
First up, Warren Buffett. He's famously said, "Never bet against America." But he's also a total pragmatist. His main rule is to invest only in what he understands, his circle of competence. If a fantastic foreign company, like those Japanese trading houses he's been buying, falls into that circle, well then for him, nationality just doesn't matter.
Then you have John Bogle, the father of the index fund and founder of Vanguard. He had a totally different take. He basically argued that since giant American companies like Coke and Apple make so much of their money all over the world, just owning a US index fund gives you all the global exposure you really need. For him, looking abroad wasn't necessary.
But Peter Lynch, our guide for this show, he saw things completely differently. He was the ultimate explorer. For Peter Lynch, a great investment is a great investment, period. It doesn't matter if it's in Peoria or Paris. His whole philosophy was perfectly captured in this simple but powerful idea. The person that turns over the most rocks wins the game.
That idea is so important we have to look at it again. The person that turns over the most rocks wins the game. Understanding that you can invest in a company like TSMC using an ADR isn't just a neat financial trick. It's your permission slip to start turning over more of those rocks yourself, to look for incredible opportunities anywhere in the world. And really, that principle isn't just about investing, is it? It's a powerful piece of life wisdom. The more you look, the more you explore, the more you're willing to venture beyond your comfort zone, the more likely you are to find something truly amazing. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a great day.